Welcome to your weekly global macroeconomic news roundup. Stay informed on the economic shifts impacting major global power.
The upside this week has been the extension of the ceasefire in the Middle East and speculations of a second round of talks between U.S. and Iran. I had my ears down on other emerging events, including U.S. plan to open a USD swap line for its Gulf allies, conflicting U.S. retail sales and consumer sentiment print, the PBOC holding interest rate fixed amid the roil from the Middle East war, Germany halving its growth forecasts, and more. U.S. retail sales jumped 1.7% in March, the strongest gain in a year, driven largely by a 15.5% surge in gasoline spending as the Iran war continues to disrupt global oil supply. Despite the boost, markets now see less than a 50% chance of any Fed rate cuts this year as inflation pressures reemerge. Meanwhile, the U.S. has lost over $50 billion in crude output since the conflict began, and analysts warn the aftershocks will last for years. At the same time, U.S. crude exports are hitting record levels, with April and May on track to be the two strongest months ever, reflecting global shortages. Financial conditions are stabilizing, with a key Bank of America risk gauge easing back toward normal levels, while U.S. stocks are rebounding as investors return, driven by easing geopolitical fears, strong early earnings, and AI-related momentum. Housing data also surprised to the upside, with pending home sales rising 1.5% to a 4-month high. Tax refunds are running 17% higher than last year, creating a roughly $50 billion boost for consumers heading into May. But not all signals are positive. Consumer sentiment fell to its lowest level since 1978, and regulators warn of rising risks in the opaque private lending sector. Globally, oil traders caution that the prolonged closure of the Strait of Hormuz is raising the risk of a recession as fuel demand weakens. Overall, the U.S. economy is showing resilience, supported by strong spending, record oil exports, and solid earnings, but remains under pressure from the Iran-driven energy shock, sticky inflation, and fragile consumer confidence.
Moving to China. China is facing a complex mix of external pressures and domestic adjustments. Exporters raised prices across more than a dozen consumer goods categories in March as the Iran war pushed up oil-related input costs, adding to global inflation risks. Tensions with Europe are rising as Beijing warns that proposed EU cybersecurity rules would seriously damage bilateral trade and could trigger countermeasures. Domestically, China's youth unemployment for ages 25 to 29 has climbed sharply, partly due to rapid AI adoption, and regulators are moving to restrict top tech and AI firms from taking U.S. investment without approval. The PBOC kept loan prime rates unchanged for an 11th straight month, as solid early-year growth and rising inflation reduced the need for easing. At the same time, China is increasingly dependent on U.S. ethane imports, which are set to hit a record this month as war-related disruptions squeeze global supply. Germany has slashed its 2026 growth forecasts as the U.S. war with Iran drives energy prices sharply higher, cutting this year's outlook to 0.5% and next year's to 0.9%. Officials warn the situation is highly volatile, with business sentiment deteriorating and fears rising that elevated energy costs could derail Germany's fragile recovery. Europe is simultaneously tightening supply chain coordination with the U.S. on critical minerals, while ECB chief economist Philip Lane says joint EU bond issuance has a fiscal logic, but requires deeper trust. Energy pressures are intensifying across the continent as LNG imports are falling, and the EU is beginning its ban on Russian LNG just as the Iran conflict disrupts global supply. Still, Europe's larger household savings buffers may soften the blow compared with the U.S. Policymakers, including ECB Vice President Luis de Guindos, stress caution ahead of next week's meeting, saying there isn't yet enough evidence to raise rates. Toronto's condo glut is turning into an investment opportunity, with High Art Capital preparing to raise over $1.3 billion to buy thousands of unsold units and convert them into rentals. In energy, the federal government approved Enbridge's $4 billion Sunrise Pipeline expansion, its first major pipeline approval under Prime Minister Mark Carney, boosting natural gas transport capacity by up to 300 million cubic feet per day. Consumer spending is holding up, with retail sales rising for a third straight month,
even as U.S. tariffs and geopolitical tensions loom. But the Canadian dollar is weakening despite higher oil prices, prompting hedge funds to turn increasingly bearish on the loonie. Prime Minister Carney said Canada's deep economic reliance on the U.S. has shifted from a strength to a vulnerability, while trade negotiator Janice Charette noted that unresolved issues ahead of the July 1 USMCA review do not imply the agreement will collapse. Business surveys show firms expect further cost increases following the Middle East conflict, and more than 80% of households believe the war will hurt the economy and push inflation higher, underscoring a cautious national mood. UK unemployment unexpectedly fell to 4.9%, due largely to base effects and a surge in self-employment, masking underlying weakness as vacancies decline and job losses rise. Inflation accelerated to 3.3% in March as the Iran-related energy shock pushed up costs, and manufacturers are now the most pessimistic since early in the pandemic. Surveys show firms expect to raise prices and see lower profits, while PMI data confirms input cost pressures are intensifying. Economists widely expect the Bank of England to hold rates steady next week, and likely through year-end, though investors are again pricing in 2 hikes as services inflation risks build. Meanwhile, higher wealth tax revenues have helped deliver the lowest deficit since 2024, even as growth remains weak, confidence deteriorates, and households grow more cautious in response to rising prices and geopolitical uncertainty. U.S. investors are returning to Japanese equities as confidence stabilizes after the initial Middle East shock, with a firmer yen helping drive renewed inflows into the tech-heavy Nikkei 225. The Bank of Japan is expected to keep rates unchanged around 0.75% this month, amid uncertainty over how the conflict will affect growth and inflation, while Finance Minister Satsuki Katayama says Tokyo remains in constant contact with the U.S. and stands ready to intervene against speculative yen weakness as the currency hovers near $160 per dollar. At the same time, Japan has lifted most of its post-war restrictions on weapons exports, opening the door for overseas arms sales to strengthen its defense industrial base. To wrap up, we expect uncertainty to persist and therefore continue to recommend more defensive portfolio positioning while considering geographic differences, with equities stronger in US and Canada and bonds holding the green light in China from a traditional portfolio positioning perspective. If you like contents like this, please like, share, and subscribe to this channel.